Hello everyone and welcome to TTT Markets. I am Fotis and in this video I'm going to explain to you how the FOMC moves the dollar. This is the secret you need to learn because this is behind every FX trend. So let's get started. When traders talk about the FOMC, they are referring to one of the most powerful decision-making bodies in global finance. This is the Federal Open Market Committee of the US Federal Reserve. So for short, we call it the FOMC. The FOMC sets the direction of US monetary policy, and its decisions ripple through every asset class, from stocks and bonds to gold, and of course the FX market. But you might ask, what is the FOMC? What is this Open Market Committee? The FOMC, or Federal Open Market Committee, as I told you, is part of the Federal Reserve that decides on interest rates and open market operations. Basically, it's how tight or loose the US monetary policy should be. They decide this. It consists of 12 voting members, and that is the 7 members of the Board of Governors, and this is in Washington, D.C., the president of the New York Fed, who always has a vote, and 4 of the remaining 11 regional Federal Reserve Bank presidents who rotate on a yearly basis. So let me say that again. There are 7 members that belong to the Board of Governors, and this is based in Washington, D.C. Then there is the president of the New York Fed that always has a vote. And then there are 4 members of the remaining 11 regional Federal Reserve Bank presidents who rotate on a yearly basis. So those 4 out of 11 are not always the same. Every year they rotate. So this is the committee. And what does it do? The FOMC meets 8 times a year. It's roughly every 6 weeks. However, there can be emergency meetings. They can be called if necessary, for example, during the 2008 financial crisis or the early months of COVID-19 in 2020. So what are they doing? This committee, they decide about the federal funds rate, which is the interest rate at which banks lend money to each other overnight. And voila, this is the federal funds rate, as you can see here on the chart. This interest rate, what is it? This basically dictates the level of interest rates everywhere in the economy. This is the rate at which banks lend money to each other overnight. While it might sound technical, it's the foundation of borrowing costs across the economy. And as I told you, it influences mortgage rates, credit cards, and yields, and everything else from government bonds to corporate loans. So what do you think happens when the FOMC raises rates like here during this period from end of 2003 until December 2006 or beginning of 2007? When they raise rates, they are trying to slow down inflation and cool economic growth. So when the committee decides that there is inflation in the system, they will do this, raise the rates. However, when they cut rates, look what happened during the crisis of 2008. They decided to cut rates, and this is supposed to encourage borrowing, spending, and new investments to support growth and employment. In the FX market, interest rates are one of the biggest drivers of currency values. Think about it this way. Currencies are yield-bearing assets. Traders and investors, they prefer currencies that offer a higher return compared to another currency that offers a lower return. Exactly the same way that bonds work. When the Federal Reserve raises interest rates, the US dollar tends to strengthen because global investors can earn more by holding dollar-denominated assets, such as the treasuries. Conversely, when the Fed cuts rates, the dollar often weakens, since the return on US assets fall compared to other currencies. Let me give you another example through interest rate differentials. Currency traders often focus on interest rate differentials, the difference between rates in two countries. So for example, this is an example between Germany and United States. If the Federal Reserve is tightening policy, while when we say tightening, we mean this is moving lower, okay? So if the Federal Reserve is tightening while the European Central Bank keeps rates low, the US dollar will likely appreciate against the euro, pushing the euro-USD lower. However, if the Fed signals rate cuts while the ECB remains hawkish, and something like this happens, the differential moves to the upside, then the dollar could weaken and the euro-USD might rise. This is exactly why forex traders constantly watch FOMC statements, press conferences, and economic projections. Even a change in the language of the committee, it can shift expectations for future rate paths, and it can of course move the market. Please keep in mind that FOMC decisions, it also influences risk sentiment. So when the Fed is tightening aggressively, so when they decide, when I say tighten aggressively, do something like this, increase rates, financial conditions, they tighten globally, making investors less willing to take risks. And what happens in that case? That means safe haven flows into the US dollar. Please remember what we said. The differential favors the dollar, so we are going to have safe haven flows into the US, Swiss franc and Japanese yen, while emerging market currencies and commodity currencies like the Aussie, the New Zealand dollar, the Mexican peso can suffer. When the Fed pivots to easing, liquidity increases, risk appetite returns, so this means that when the Fed eases, it's like this, liquidity increases, the cost of money is becoming less expensive, risk appetite returns, the dollar weakens, and this is making investors move back to more appealing currencies, to riskier assets, as they call it. So what should you keep from this video? The FOMC is not just a US event, it's a global catalyst. Every FOMC decision can shift rate expectations worldwide, drive cross-border capital flows, and set the tone for global risk sentiment. So practical tips, what should you do as a forex trader? Number one, the most important, always check the FOMC calendar. So avoid opening large positions right before the meeting. And also you can go to the CME Fed watching tool. So this is telling you what is the probability that they are going to do something. Cut rates, increase rates, what are they going to do? So to see what the market is expecting. So here I am, CME Group, the Fed Funds Futures. So you can see here, there is a 99.9 probability that they are going to cut by 25 basis points. Why do you need to know this? Because anything different than this is a surprise, and that can move hugely the market. If they decide not to cut, which means the probability is 0.1, that could be very important for the markets. This is a surprise. And I think it could be very negative for stocks, for equities. If they decide to cut 50 basis points, the market doesn't believe this is going to happen, zero probability, but you can imagine what it means if there is a surprise. So what moves the market is the surprise. It is expected that they're going to cut by 25 basis points. So we pay attention in case there is a surprise, as I said. And please remember, after the decision, focus not only on the decision, but also on Powell's testimony and guidance. Remember that the first reaction when it comes to FX can often be a reverse. Traders digest the data, interpret the tone, and then they trade accordingly. What does this mean? It means you can get a move initially against the main trend, and then as the data are absorbed, it moves violently sometimes in the right direction. If you are a day trader, you might say, well, this is not for me. Well, it is, because this decision, this FOMC meeting, it is deciding everything when it comes to your trading. It influences interest rates, yield differentials, global sentiment. It is one of the most important forces shaping currency markets. Understanding how it works and anticipating how the market might react, it is a crucial skill for every trader and that you need to learn. Thank you for watching us here at TTT Markets. See you in the next video.